public debts around the world have gotten to very high levels. So Japan's obviously at the forefront of that, but then when you look across Europe, you look at the United States, many countries around the world, they've built up very large public debts, and so they're running into more imbalances on that end as well. They risk running into a fiscal spiral, which is to say that the interest expense on their public debt starts to become untenable.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses the financial system. According to Lyn Alden, both central banks will retain assets denominated in dollars. And the issue Lyn Alden believes we're facing in the contemporary over the course of decades, the system has developed extremely significant imbalances. And two of those primary ones are the net international investment position and trade imbalances. Imbalances: the United States has maintained structural trade deficits in order to provide the world with money, akin to a feedback loop that develops within the system, leading to significant money being lost into the rest of the world, after which the other countries take those dollars and utilize them to purchase assets from the United States. They purchase our loans, equities, and real estate, as well as our private equity, which is how we wind up. One type of imbalance is when the foreign sector owns an increasing portion of our capital stock. That continues to rise. And the other is the fact that public debt has reached extremely high levels globally, and lots of things Lyn Alden discussed. So please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
Sure, and I think it depends how far up you want to go or how long you want to go. But basically, the high-level view is that a lot of this actually is technology-based. Basically, that in the modern era, as we use telecommunication systems, the telegraph, the telephone, the internet, and all that, we got to a point where our transactions move around the world at the speed of light, and matter does not. And so we used to base our money on gold and various ways to move around gold, either legally or sometimes physically. But in the past 50 plus years, we've completely decoupled from that. And so we exist in a world where there's 160 different currencies, roughly speaking, and they all kind of have their own centralized central bank bubble and capital controls kind of around their borders. And they loosely tie together with their world reserve currency. So in the prior era, they partially tied together through Britain's currency, basically centralizing around London. And in the current era, they tie together around the Federal Reserve in New York. And so the global financial system is in some way a barter system. If say Nigeria and Korea want to do a transaction, the challenge is what do they denominate that unit in? And for the most part, it tends to be dollars, and both central banks will generally hold dollar-denominated assets. And the problem I think we're running into in the modern time is that after decades of the system, it's built up very large imbalances. And a couple of those main ones are, one is the trade imbalances and the net international investment position imbalances. So in order to supply the world with dollars, the United States has run structural trade deficits. This is kind of a feedback loop that materializes in the system. And so it results in a lot of dollars getting out into the rest of the world, and then the rest of the world takes those dollars and then buys U.S. assets with them. So they buy our stocks, they buy our debt, they buy our real estate, they buy our private equity. And so we end up having a larger and larger percentage of our capital stock owned by the foreign sector. That's one kind of imbalance that keeps building. And the other one is that public debts around the world have gotten to very high levels. So Japan's obviously at the forefront of that, but then when you look across Europe, you look at the United States, many countries around the world, they've built up very large public debts. And so they're running into more imbalances on that end as well. They risk running into a fiscal spiral, which is to say that the interest expense on their public debt starts to become untenable. And I think the main pivot point we reached was in the past decade or so, right? So for example, for 40 years, you had in the United States rising public debt as a percentage of GDP, but it was offset by structurally falling interest rates. And so the interest expense, as both in absolute terms and especially as a percentage of GDP, was not particularly problematic in the acute sense. But after we got down to zero rates and kind of bounced off zero, and now we're going sideways to up, that is no longer offsetting the rising public debt. And so actually we're getting to the point where interest expense is actually becoming a very meaningful problem. And so that's kind of where the world faces itself fiscally, monetarily, and obviously there's a lot of directions we can go from that point.
Lyn Alden believed the key turning point we reached was over the past decade or so. For instance, in the United States, there has been a continuous increase in public debt over the past 40 years. The structurally declining interest rates, which had an impact on the interest expenses, offset the percentage of GDP. In terms of absolute values, and particularly as a percentage of GDP, the situation was not overly concerning in the short term. After reaching zero rates and then moving away from zero, we are now experiencing sideways to upward movement, which is no longer the case. Balancing the increasing public debt has led to interest expenses becoming a significant concern. So that's where the world finds itself financially and monetarily, and there are numerous possible paths forward. Progressing from that stage, let's back to Lyn Alden Interview.
So it depends on what starting point you look at. I mean, fascinating, the national debt clock went up in the United States in the late 1980s. One of the most successful independent presidential campaigns in history was Ross Perot, who ran largely on the debt and deficit. That was in the early 90s. That was kind of the peak zeitgeist for the public debt being a problem. But that was also roughly when globalization accelerated. So China connected to the rest of the world, started becoming a cheap manufacturing hub, connecting a lot of labor to Western capital. The Soviet Union fell, and all those borders and trade routes opened up until fairly recently. And so you had kind of 30 years of globalization, which was disinflationary, along with the internet and technologies and things like that. And so we kind of ushered in this era of falling interest rates. And so a lot of people that were concerned around the acuteness of the public debt back then were a few decades early. And so I think now a lot of people have gotten into their view that debts don't really matter, that it can always be pushed away. And I think that's generally the wrong lesson to have learned there, because we no longer have these structurally falling interest rates that they started with back then. Now we have, like you said, well over 100% debt to GDP, and we no longer have a structurally falling interest rate to offset some of that. Instead, I think the main kind of offset or variable to monitor in terms of timing is kind of the overall energy and productivity side, right? So if you have large deficits, ongoing currency debasement, for example, that might or might not show up in CPI inflation depending on what else is happening. If we're building a lot of new energy production, if AI is making things way cheaper, for example, if there's all these kind of offsets, these better productivity, better energy resources, better kind of usage of every dollar, then you can get that offset where there's more dollars, but things still are not rising too much on average. However, if you get energy shortages, if AI does not give the rapid productivity growth that some of the bulls think, then you don't have those offsets. And I think that's the biggest variable to probably monitor is what is going to be like the magnitude of those offsets over, say, the next 5, 10, 15 years versus the rate of fiscal spiral and debasement that's happening on the other side of the equation. I tend to lean towards I think AI is going to be a deflationary force on certain types of wages, especially white collar wages. But that I'm not as, I think the energy section is where we could have some material kind of cost increases. Maybe not the next 12 months, but as we get further into this decade, I think that's a realistic concern.
According to Lyn Alden, the national debt in the late 1980s, the economy in the United States experienced a significant upturn, leading to one of the most successful independent presidential campaigns. One of the most notable campaigns in modern history was Ross Perot's, focusing heavily on the debt and deficit of the early 1990s. It was the epitome of the public debt becoming a concern for many. Around that time, globalization started to pick up speed, leading to China becoming more interconnected with the rest of the world, transitioned into a cost-effective manufacturing center, linking abundant labor with Western capital after the collapse of the Soviet Union. Those borders and trade routes opened up fairly recently, and so there were about 30 years of globalization. Contributed to disinflation, just like the internet and technologies. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.